Gold just hit $5,000 per ounce. The headlines are celebrating. The gold bugs are vindicated. The stackers are posting screenshots of their account balances. But here's what nobody's saying. $5,000 gold isn't a victory. It's a confirmation that the monetary system is failing in real time. This isn't about getting rich. This isn't about being right. This is about understanding that when gold reprices this violently, something fundamental just broke in the architecture of global finance. And if you don't understand what broke, you won't know what to do next. Today I'm going to explain what $5,000 gold actually means, not for the price, for the system, for your wealth, for what comes after. Let's start with the mechanism that drove gold from 2,800 to 5,000 in less than a year. This wasn't retail buying. This wasn't a short squeeze. This wasn't even institutional FOMO. This was central bank panic buying meeting sovereign wealth fund diversification meeting currency crisis response. Look at what happened in the 12 months leading to this moment. The U.S. debt ceiling fight in March 2025 triggered a Treasury auction failure. Not complete failure, but yields spiked to 7% on 10-year notes before the Fed intervened. The European central bank crisis we discussed escalated. Italy's bond yields hit 6%. The ECB had to choose between saving Southern Europe or fighting inflation. They chose to save Europe. They announced unlimited bond buying. The euro fell 8% in 3 weeks. 3 emerging market currencies collapsed completely. Turkey, Argentina, Egypt all entered hyperinflation. Their central banks bought every ounce of gold they could access. And then China made the announcement that changed everything. In October 2025, the People's Bank of China revealed they'd been underreporting gold reserves for 5 years. Their actual holdings, 14,000 tons, not the 2,000 they'd been claiming. That revelation told every other central bank, the Chinese know something, and they've been positioning for years. The scramble began. Here's what $5,000 gold tells you about sovereign balance sheets. Remember the gold coverage ratio we discussed? At $2,800, U.S. gold reserves covered about 6% of the money supply. At $5,000, that coverage jumps to 11%. Still not the 20% that would signal a formal partial gold backing, but meaningful enough that the U.S. government's balance sheet looks less catastrophically insolvent. And that's the point. $5,000 gold is the market doing what governments needed but couldn't explicitly decree, revaluing gold high enough to provide meaningful backing to currencies without requiring a return to a gold standard. This is the 1933 Roosevelt revaluation playbook, happening through market forces instead of executive order. The U.S. government didn't need to confiscate gold. They just needed the market to reprice their 8,000 tons from $224 billion at $2,800 per ounce to $1,296 billion at 5,000. That's over $1 trillion added to sovereign asset values without printing a single new dollar. Other governments experienced the same windfall. Russia's gold reserves doubled in value. China's, at their real holdings of 14,000 tons, went from $392 billion to $2,240 billion. These aren't trivial numbers. These are sovereign balance sheet stabilizers that buy time for currencies under stress. Now let's talk about what this means for the dollar specifically. $5,000 gold coincided with something most people missed in the headlines. The dollar index fell to 88. That's a 15% decline from its peak of 103 in 2024. Gold rose 79%. The dollar fell 15%. The combination tells you this wasn't just gold appreciation, it was dollar depreciation accelerating. But here's the critical nuance. The dollar didn't collapse. It declined in an orderly fashion while gold repriced. That's exactly what policymakers needed. A disorderly dollar collapse would have triggered global crisis. Trade would freeze, credit markets would seize, the entire euro-dollar system would break. An orderly decline, 15% over 12 months while gold absorbs the revaluation, allows the system to adjust without breaking. This is managed decline, not failure, not collapse, controlled debasement with gold acting as the release valve. And that distinction matters enormously for what happens next. Here's what most people get wrong about this moment. They think $5,000 gold means they won. They beat the system. They were right and everyone else was wrong. That's ego, not analysis. $5,000 gold means the system is transitioning to a new equilibrium. You're not beating the system. You're surviving the transition that the system itself is engineering. Let me show you what I mean. If you bought gold at $1,500 in 2020 and held to $5,000 today, you made a 233% return. Extraordinary. Better than almost any other asset over the same period, but your purchasing power didn't increase 233%. Why? Because while gold was rising, everything else was rising too. Housing prices up 45%, food prices up 38%, energy up 52%, healthcare up 41%. Your gold preserved your purchasing power through a period of significant currency debasement. It prevented you from getting poor while others got poor. But it didn't make you rich. That's the function of monetary assets in currency transition periods: preservation, not creation. So what do you do now? That's the question everyone's asking. First, understand where you are in the cycle. $5,000 gold is not the top, but it's not the beginning either. We're in the middle phase. The revaluation has been validated. The market has repriced gold as a monetary asset backing currencies, but the system hasn't fully transitioned to whatever comes next. That transition could take 5 years, could take 10. During that time, gold will be volatile. It might go to 6,500, it might pull back to 4,200. It will frustrate and disappoint and create doubt. Your job is not to trade that volatility. Your job is to hold your core position through it while the system completes its transition. Here's the framework I'm using. If you allocated 10 to 15% to gold when it was under 3,000, you're now sitting on massive gains. That 10% allocation might now be 18 or 20% of your portfolio purely from appreciation. Don't rebalance back to 10%. That would be selling your best performing insurance policy right as the crisis it was insuring against is manifesting. But don't let it become 30 or 40% either. That's too much concentration in a non-yielding asset. My rule: let winners run until they hit 25% of total portfolio value. Then trim back to 20%. Use proceeds to rebalance into productive assets that are undervalued. Let me address the FOMO question directly. I didn't buy at 2,800. Should I buy at 5,000? That depends entirely on whether you own any gold. If you own zero gold, yes, you should buy some at 5,000 because the transition isn't over, because your portfolio is still 100% exposed to paper asset risk. Start with 5%. That's conservative at these prices, but better than zero. If you already own gold, if you bought at 3,000 or 3,500 and you're sitting on gains, don't chase. Don't add aggressively at all-time highs. Let your position do its job. It's already working. Let it compound quietly while you focus on other opportunities. The mistake most people will make is buying at 5,000 after watching it run from 2,800, then panicking and selling at 4,200 when it corrects. That's how you lose money in a bull market. If you missed the move from 2,800 to 5,000, don't try to make it up by over-leveraging now. Accept that you missed it and position appropriately for the remainder of the cycle. $5,000 gold. It's not the end. It's not even the beginning of the end. It's the end of the beginning. The monetary system just confirmed it needs gold repriced to maintain stability. That confirmation is permanent. The repricing may have further to run, but the fundamental shift has occurred. Your gold preserved your wealth through the first phase of this transition. Now your job is to hold through the volatility of the middle phase and not give back those gains through emotional trading. The system is changing. Gold is your anchor through that change. Use it wisely.